Stock market moves in cycles. There are two basic cycles. And rather than getting caught up in the minutia of every 30 minutes why the stock market did something, we look at the cycles. The long-term cycles tend to run 10 to 20 years on average, and the shorter-term cyclical cycles normally run 3 to 9 years. They could be a little more or a little less. But this is what a cycle looks like. And it doesn't matter if it's the economy, if it's a debt cycle, if it's the stock market. They all tend to move in cycles. When we're in a recession, usually the stock market is at a low. We've had tremendous defaults in the debt market, and you're at a bottom. As the economy recovers, as people start to engage in more leverage, as incomes rise, investment grows, the cycle goes up. And the cycle doesn't stop at the long-term mean. It keeps going until it's gone way too far and the economy's overheated. There's too much debt. It's past due. People aren't able to pay their debt, and the stock market is trading at PE multiples never seen before. And that's when things turn and we go through the cycle again. It's human nature not to keep the cycle moving at the mean. Cycles have more potential to wreak havoc the further they progress from the midpoint, or the greater the aberrations or excesses. The most dangerous words in stock investing is "this time is different." And we've heard it at the peak of every cycle from the early 1900s to today. It's important to understand where you are in the cycle when you're investing. You see, most people just say, well, you just buy it and hold it for the long term and you're going to do fine. Well, what's your time horizon? Is it 100 years? 120 years? Or is it 20 years? For instance, if you had invested at the beginning of the last secular bear market prior to the financial crisis in 1982-83, you would have had 18 years of tremendous growth. So that would have worked out fine. But what if we were at the top in 2000? And that was the start of your 20-year investing time frame. And you held until 2009 when you retired or wanted to retire. That's why we believe it's important to understand that the cycles and understand where you are in the cycle. When you get to the top of the cycle, we have what we call the anatomy of a bubble. You have the stealth phase, the awareness phase as it's first starting to build. Valuations are starting to get frothy. The mania phase, when everything goes crazy. Now, last year when I spoke to you, I said I felt like we were somewhere in this delusion to new paradigm phase. Anybody remember what happened in the fourth quarter last year? We had the worst December in the history of the stock market. I believe now, even though we did get a bounce up this quarter, that on some indexes went higher than before, many indexes never broached the previous highs. I believe personally that we're here, but I'm going to let you see the data, and I'm going to let you be the judge of where we are and where you think we're going.